The government can put $50 into your Social Security check and still make you poorer. Most retirees never understand that sentence until the damage is already done. They see the headline, cost of living adjustment, increase relief, a little more money, a little breathing room, and then somehow the checking account still feels tighter. The grocery bill still feels heavier. The Medicare deduction keeps growing. The tax bill shows up like an insult. And they sit there wondering how a raise managed to feel like a pay cut. I understand exactly how that happens. Retirement income is not usually destroyed by one dramatic blow. It is drained quietly, through a series of small openings. Most people never notice, until enough money has leaked out, that the difference starts changing what they can afford, what they postpone, what medicine they refill, what trip they cancel, what help they do not offer a grandchild, what house repair they keep delaying. That is the line I want you to hold in your mind. Your retirement check is not a number. It is a container, and the entire game is about whether that container is being filled faster than it is leaking. Most people watch the fill. Very few people study the leaks. That is why they spend their final decades feeling as if something is always slipping through their fingers. When I look at a retirement system, I do not begin with what it promises. I begin with what it quietly removes. That habit has saved me a fortune in business. It matters just as much in retirement. A good investor does not merely ask what an asset earns. He asks what friction eats the return before it reaches his hands. Retirement works the same way. The May changes people are hearing about are important, but not for the reason most headlines suggest. The real story is not that one thing changed. The real story is that millions of retirees are finally seeing how the leaks work. Some of those leaks are old and cruel. Some are legal and routine. Some can be appealed. Some can be planned around. Some can be reversed. But they all have one thing in common. They punish the passive retiree and reward the informed one. That is the difference between slowly watching retirement disappear and actually protecting it. The first leak is what I call the paper raise. On paper, a cost of living adjustment looks like protection. You are told inflation happened, therefore your Social Security benefit is rising, therefore the system is working, and technically that is true in the narrowest possible bureaucratic sense. The check is bigger, but a bigger check does not automatically mean a stronger retirement. That is where people get tricked. The official inflation number is built from a broad basket of spending across the general economy. Retirees do not live inside the general economy. Retirees live inside a very specific economy. Their money goes disproportionately to medicine, insurance, housing, utilities, food, repairs, and services that do not politely stay inside the government's favorite narrative about what inflation is supposed to look like. So a retiree gets a 2.5% increase and is expected to feel grateful. Fine, now compare that to what actually rose in the categories they depend on. Healthcare does not ask permission from your COLA. Home insurance does not care what the broad index said. Prescription costs do not pause because Washington declared the increase adequate. That is why a paper raise often becomes emotional camouflage. It makes the recipient feel as though something helpful happened while the practical buying power keeps shrinking. I do not say this to make you cynical. I say it because once you understand the paper raise, you stop confusing nominal comfort with real protection. That is step one in growing up financially. The second leak is much uglier because it was never really a leak at all. It was a sanctioned theft dressed up as policy. I call it the pension penalty. For years, millions of public sector workers were punished by two rules most Americans never heard about until those rules bit them directly. The windfall elimination provision, the government pension offset. Cold names for a very human result. A teacher works for decades in a system with its own pension. A firefighter serves his community and also has other work history that paid into Social Security. A police officer, a postal worker, a state employee, a municipal worker, a widow whose spouse paid into the system his entire life. All of them look at retirement expecting two things to behave like two things they earned. And then the system says no, it says your Social Security benefit is going to be reduced because of the pension you have. It says your spousal or survivor benefit may be reduced or eliminated because your public pension somehow counts against what your spouse earned. It takes work that was separate, money that was separate, years that were separate, and then merges them into a penalty. That is what I mean by theft dressed as policy. No market crash caused that. No personal failure caused that. No bad investment caused that. It was a rule, and rules are often the most expensive thing in retirement because people assume rules are final. Now, when a bad rule finally dies, the practical effect is simple. The leak begins to close. For millions of people, the elimination of those provisions means the check they thought was just how it came out was never the real number. They were living under a false number, a smaller number, a number that trained them to lower their expectations around a system that had already taken enough from them. That is why these adjustments matter so much. Not because politicians suddenly became wise, because an old penalty is being removed and real dollars are finally moving back toward the people who earned them in the first place. Some retirees are going to see larger monthly checks. Some will see retroactive payments. Some will realize for the first time that the benefit they accepted in silence was wrong all along. There is a lesson in that, and it is bigger than Social Security. Never assume the number on a government statement is the number reality intended for you. Always ask how it was built. Always ask which formula touched it. Always ask which rules suppressed it. And when old penalties disappear, do not wait for the machine to volunteer every last dollar. Machines are not generous. They are administrative if you are affected. You follow up. That is what ownership looks like in retirement. The third leak is the one almost everybody experiences, and very few people respect enough. I call it the premium siphon. Most retirees do not write a check every month for Medicare. Part B, the system simply reaches into their Social Security and pulls the money out before the deposit ever lands. That is why the leak is psychologically effective. When money vanishes before you touch it, your brain stops treating it as a decision. It begins treating it as weather. That is a mistake. A deduction that arrives automatically is still a claim against your retirement container. And when the standard premium rises, it does not just increase a medical expense. It intercepts your COLA before your household has the chance to use it. That is why a retiree can hear your benefit is up and still feel no richer at all. Part of the increase gets eaten on the runway, and for some people, the siphon becomes far more aggressive. This is where the system's favorite little ambush appears. IRMA, the income-related monthly adjustment amount. A beautiful example of how retirement gets more expensive through delayed consequences instead of immediate honesty. The logic is simple enough. If your income from 2 years ago was above certain levels, Medicare charges you more now. Now think about how easy that is to misunderstand. You sell a property, you realize capital gains. You take a large retirement account distribution, you convert money to a Roth. You have one unusually strong or unusual tax year. And then 2 years later, your Medicare premiums are higher because the system decided that the version of you from back then is still the version of you now. That is not just expensive, it is confusing by design. What matters most is this. A surprising number of retirees assume those numbers are fixed. They assume that once the higher premium appears, the verdict is final. It is not always final. If your income changed because you retired, lost work, lost a spouse, divorced, or had another qualifying life event, you may have grounds to appeal. That matters enormously. One appeal can close a leak worth hundreds of dollars every month. Do not underestimate the compounding effect of that. People hear a couple $100 and think in monthly terms. I do not. I think in lifetime terms. I think in years of expenses. I think in reduced portfolio withdrawals. I think in medications funded, repairs handled, stress lowered, optionality restored. That is how grown investors think. A leak of $200 a month is not minor, it is structural. The fourth leak is what I call the work clawback. A great many retirees do not walk cleanly from full-time work into full retirement. They phase out, they consult, they work part-time, they pick up seasonal work, they bridge income in order to protect savings or preserve dignity, or simply because life rarely changes in one neat motion. There is nothing wrong with that. But if you are collecting Social Security before full retirement age while still earning income, the system is watching that too. Above certain earnings limits, benefits are withheld. Not gone forever, but withheld. And to the retiree trying to pay actual bills in actual time, a withheld dollar behaves exactly like a missing dollar. This is one of the places where people get emotionally ambushed. They feel as though the government is punishing them for still working. And in practical cash flow terms, that is not an unreasonable feeling. Later adjustments may technically restore some value, but that does not change the pressure now. So the right move is not outrage. The right move is precision. If you are still working and collecting, know your earnings relative to the limit. Do not guess. Do not ballpark. Do not hope it all comes out fine. Retirement systems punish vague people first. Precision is protection. The fifth leak is the tax echo. This one makes people the angriest, perhaps because it feels the most offensive. You pay into the system all your working life. Then in retirement you discover that your Social Security can become taxable depending on your combined income. And the thresholds that govern this are old enough to belong in a museum, yet still active enough to drain modern retirees. This is not an accident of timing. It is a mechanism. The government does not need to officially raise taxes on retirees in some dramatic public fight. It can simply leave old thresholds frozen while benefits and other income sources rise around them. Over time, more and more people get pulled into taxation without a politically noisy vote on the issue. That is the tax echo. The original dollar was taxed when earned. The benefit gets taxed again on the back end, and every year inflation quietly pulls more people into the range where this becomes real. That is why I distrust static thresholds in a moving world. Frozen thresholds are often just deferred tax increases wearing a disguise. A retiree who understands the tax echo does not ask only, "How much am I receiving?" He asks, "What does one extra withdrawal do to my total combined income? How much more of my benefit becomes taxable if I realize this gain, take this IRA distribution, or earn this extra money?" The uninformed retiree sees separate decisions. The informed retiree sees one connected tax machine. That distinction changes everything. Now, if you put these leaks together, you begin to see the real shape of the problem. The paper raised tells you that you are being protected. The pension penalty teaches you that rules can suppress a benefit you thought you earned. The premium siphon shows you that automatic deductions can eat the increase before it reaches your hands. The work clawback shows you that flexibility has limits if you do not know the earnings rules. The tax echo shows you that income can circle back and strike the same household twice. And all of this is made worse by the oldest force in finance information delay. That is the sixth leak. It is not on a statement. It is not a line item. It does not announce itself, but it may be the most expensive leak of all. The people who protect retirement are usually not the people with the fanciest advisors or the greatest luck. Often they are simply the people who learn what changed before the money is gone. The difference between a retiree who knows and one who does not can amount to thousands of dollars. And the difference did not come from intelligence alone. It came from attention. That is why I tell people the first identity change retirement requires is this: stop acting like a passive recipient. Start acting like a benefits auditor. That is the identity flip most people never make. They spent their working lives as earners. Then they move into retirement still behaving as if institutions will do the checking for them. They will not. Social Security will not care about your confusion. Medicare will not slow down because you missed a threshold. Tax law will not pause because the rules were buried in jargon. You must become the person who checks the record, checks the deduction, checks the work history, checks the formula, checks the appeal path, checks the earning limit, checks the tax impact. That is not paranoia, that is ownership. And ownership is what separates people who slowly lose control from people who keep it. So what is the practical blueprint? First, verify the container, log into your Social Security account. Pull your statement, review your earnings history. Your benefit is built on your highest earning years. If a year is missing or wrong, The leak began before retirement even started. Correct the record. Investigate old penalties. If you or your spouse worked in the public sector under a pension system that did not pay into Social Security, do not assume your current number is correct. Now that those old provisions have changed, ask, call, confirm, follow up. A wrong assumption here can cost you years of underpayment. Third, inspect the premium siphon. If your Medicare Part B premium is above the standard amount, ask whether your current life still resembles the tax year the system is using against you. If not, look at the appeal path. A retired person paying working person premiums based on an outdated snapshot is funding someone else's convenience with his own retirement. Fourth, measure the work clawback before it hits. If you are collecting benefits and still earning money, know the earnings limit and where you stand relative to it. A surprise withholding is not a financial strategy. Fifth, map the tax echo. Estimate your combined income before year. End surprises do it for you. Understand what causes more of your Social Security to become taxable. Learn to see withdrawals, gains, and income as interacting valves, not isolated events. Sixth, create a review ritual. Retirement is not a one-time filing event. It is an operating system. Once a month, once a quarter, once a year, whatever rhythm keeps you honest, but make it a system. Systems beat memory, systems beat hope, systems beat the lazy comfort that tells people, it is probably fine. It is the phrase, probably fine, that ruins more retirements than bad markets do. Now I want to tell you the deeper truth underneath all of this. A lot of retirees think the threat to their future is running out of money in one dramatic catastrophe. That can happen. But more often what actually happens is slower. A little more to Medicare, a little more to taxes, a little less because of an old offset rule, a little confusion about what is appealable, a little ignorance around how work affects benefits, a little inflation that the official adjustment does not truly catch, a little more portfolio withdrawal to cover what the check no longer covers, and after enough years of a little, the structure changes, confidence falls, options narrow, small luxuries disappear, anxiety rises. The person starts saying no to things they should have been able to afford because the system had a dozen ways of turning one check into a weaker check without ever labeling it that way. That is why information matters so much. Not because information is glamorous, because every leak begins as an unnoticed fact. The retiree who protects his life is not the retiree who trusts most. It is the retiree who verifies most. I have always believed that a person should understand any machine that claims a long-term share of his future. Social Security is such a machine. Medicare is such a machine. The tax code is such a machine. If they can reach into your retirement every month, then your duty is to understand how. Not approximately, actually. This is not about fear. It is about refusing to live passively inside systems that get richer from your inattention. So let me leave you with the line that matters. Your retirement does not disappear all at once. It leaks. And once you understand where the leaks are, you stop feeling helpless. You stop calling every reduction just the way it is. You stop accepting every line on every statement as final truth. You stop acting like a spectator to your own money. That is the real shakeup. Not that a rule changed in May. The real shakeup is the moment you realize how much of retirement is won by the person willing to inspect every leak before it becomes a flood.